Wow, lots has happened over the last few weeks and months, and I'm here to give you a taste of what I'm watching for the remainder of February and into the month of March. Be sure to watch this video until the very end for bonus information on Friday's Supreme Court decision, which struck down Trump's IEPPA tariffs, and we'll talk about how the market reacted. I'm Valerie Leonard, founder of EverThrive Financial, and each month my goal is to give you straight talk and insights so that you can hopefully grow and protect your money. Here is a 20-year look back chart of the S&P 500 as of the close of business on Friday, February 20th, and clearly you can see that the long-term upward trend appears to still be intact. If you go all the way back to the bottom of 2009 during the financial crisis, and you'll see in the far right-hand top corner that the market recently has continued to make all-time highs. And when we zoom in and we look at the past 5 years, what you'll notice in the far right-hand top corner is that the market has turned downward slightly in recent weeks. And that's primarily been driven over a narrative that AI has the potential to sink the economy. Of course, that narrative sounds very scary, but in reality, the market really isn't behaving like those types of risks or anything other than rhetoric at this point. Now, I want to take a look at 2025 performance across asset classes. I think this is going to give you some great insight into what we're seeing now. So just as a quick reminder, in 2025, all major asset classes had positive performance. And since the start of this year, we're seeing other areas do well. And we're also starting to see some areas lag. We're going to talk more about that here in just a second. But if you'll notice on this chart, you can see that the international space in the top right-hand corner, that red box, was the best performing category in the 2025 calendar year, up 32%, followed by large cap growth up 18.5%. Large cap value companies in the purple box were up nearly 16%, followed by commodities up almost 16%. So think corn, copper, wheat, those kinds of commodities in general. And then small cap growth and small cap value were both up right around 13%. Global real estate in that green box up almost 9%. Fixed income, which represents the bond market, up over 7%, and then cash was up over 4% in 2025. So let's take a look at sector performance. And this is where it gets really interesting. So you can see sector performance in 2025, but you can also see sector performance so far this year. And at the end of 2025, we saw that communications and technology were the two highest performing sectors. You can see that here in the box, up 33% and 24% respectively. But so far in 2026, we've seen technology dip and we've seen communications fall to the middle of the pack. And we are 7 full weeks into the trading year. And this year, energy, industrials, consumer staples, and materials have all boomed, while the market in general, which is represented here by the S&P 500, which is that bottom right-hand box, we've seen the market up only slightly just since January 1st, up 0.24%. Now, you probably well know if you've invested for any period of time that there's natural fluctuations in the market, and year-to-date numbers aren't standalone reasons to make hasty or even emotional investment decisions. But we just want to kind of remind you and kind of set the stage of what has performed, what is performing right now. And the fact that last year's winners are now lagging is simply just how healthy markets sometimes behave. And so here at EverThrive, we're constantly digging into the data and we're making sure to keep our clients and our YouTube subscribers informed of any major concerns or potential opportunities. And on that note, one really important thing that we think investors should be aware of is the tech rotation, which we also call sort of the change in tech leadership. So throughout the past few years, I've shared in our YouTube videos that the Magnificent Seven companies, which are some of the largest companies out there, those 7 companies have made up over 30% of the S&P 500. And these stocks were really outperforming up until the end of 2024. But then in 2025, only 2 of the Magnificent Seven companies beat the S&P 500, as you can see on the left side of this chart. And then today, what you'll find is that there are 10 companies. We're going to call them the Magnificent 10. Those are represented here. You can see Broadcom, Apple, Tesla, Microsoft, Meta, Amazon, Google, NVIDIA, Palantir, and AMD. Those are the Magnificent 10 companies. Those 10 companies represent nearly 41% of the S&P 500. So in other words, the performance of the S&P 500 is largely dependent on only 10 companies, whereas the other 490 companies in the index represent the remaining 59% of the index's makeup. And we call this concentration risk. If something major happens to one of the big 10, it really does have the potential to dramatically impact the performance of the overall stock market or the S&P 500. And this does lead to increased risk to investors. So this is why diversification is very important. If you remember back that colorful chart that I showed you earlier, and I'll put it back up on the screen, notice that there's not one color that's always at the top and there's not one color that's always at the bottom. And so this leads to a case for diversification because we can't predict from year to year how each company is going to perform. But diversification is very important. And I think it's even more so important in 2026 with concentration risk being a bigger risk in investors' portfolios than it has been in years past. And while the Magnificent 7 or 10 companies may be potentially setting up for another run higher, it's still way too early to tell. And it's important for you to know your own personal tolerance for taking risk, allocate your portfolio accordingly, and then put your emotions on the shelf. So any tech dominance that we have seen, this is something that we're watching in this rotation. We're going to watch it closely and we'll certainly keep you updated. Okay, let's move on to news that potentially could move markets in the future. The big news is Kevin Warsh, a former member of the Federal Reserve Board of Governors, was nominated by President Trump to take over the Federal Reserve chairman position that Jerome Powell currently sits in. And this will take effect mid-May, assuming that Warsh is confirmed by the Senate. So if he is confirmed, we expect to see rate cuts later this year. It's likely that there probably won't be another rate cut until June when Warsh takes over at the Fed. But here's what you need to know about Warsh. So he may be likely to cut interest rates, especially in the short term, but we also think that he's going to simultaneously try and shrink the balance sheet over the next several quarters. So when I say shrink the balance sheet, all that means is that when the U.S. issues treasury bonds, those treasury bonds have a maturity date. And when they mature, the Fed likely isn't going to issue new treasury bills to replace them. So what does this do? Well, it sucks money out of the market so that banks have less reserves on hand and ultimately less money to lend. And this can put upward pressure on long-term interest rates, like say 30-year mortgages, for instance. But it ultimately can also work to keep inflation in check. So why would 30-year mortgage rates rise when I just said that Warsh will likely keep rates low? Well, that's because he has what I refer to as a split interest rate policy. It's a strategy that where I think it signals that he thinks inflation is moderating enough to warrant lower interest rates, but also at the same time that the financial system is healthy enough for the Fed to start sucking liquidity out of the system. And in other words, that means that they're trying to normalize things. Warsh has indicated that he has concerns about the level of money the U.S. Treasury has printed over the years and also the level of national debt. So in the end, this type of policy could lead to longer long-term interest rates, but lower short-term interest rates. So borrowers that are looking to borrow money over the short run could expect to pay lower rates, and those that are looking to borrow money over the longer run potentially could expect higher rates. So what I just described, that's what we call the yield curve. So in other words, if you buy a bond with a long-term maturity date attached to it, you can expect to get paid a higher rate of interest over that long term because there's lots of risk over that long period of time, let's say 30 years. Whereas if you want to buy a bond that matures in the next month or so, you can expect to get paid less in interest because you can really better understand the risks that you may be facing over the next month or so than say the risks over the next 30 years. So that's why the interest that you would receive on a shorter term bond is theoretically lower. And we expect the yield curve line that you see here to get steeper as short-term rates come down and long-term rates go up. And we just don't know the timing of when the Fed may implement policy changes like this. And so we don't know when that might influence this type of yield curve steepening. Before we wrap up, I do want to just do a quick lightning round of other updates. We are definitely seeing a raging bull market across the pond. We're seeing global markets, including Mexico, Israel, Japan. Those are all areas where we're seeing strong performance. We've talked already about, the fact that the yield curve could change. That may drive some additional volatility or fear in the market, but right now it's not a concern. And also, we did see a pullback in silver and gold recently, but I think this was due in part to everyone wanting to be in gold and silver, and it ebbs and flows. Supply and demand definitely is something we watch closely. And silver, of course, has gone back up, and I remain bullish on gold over the long run. All right, now to the bonus. On Friday, the Supreme Court did strike down Trump's policies under the International Emergency Economic Powers Act, and they said that those tariffs were unconstitutional. So this was expected by most, and the market reacted by rallying upward on Friday on that news. So I just want you to keep in mind that IEPPA tariffs that we're talking about here really only represented about half of the import taxes that the government is collecting every month, because other types of tariffs were issued under different policies, and those were never, ever being challenged. So today, Saturday, February 21st, Trump reacted by saying that he was going to increase global tariff rates from 10% to 15%. And, so I think there's still a lot of uncertainty out there when it comes to trade policy. There are other ways that Trump could restore most of these tariffs. And the Supreme Court didn't state that the refunds were due. I think they're going to allow lower courts to rule on that part of the equation. But while we do know that trade policy remains uncertain, we do know that this decision overall is likely to have an impact on the U.S. Treasury market, because these revenues may eventually be lost, right? Especially in the short term. And when you're thinking about consumer retailers who import large quantities of goods, we don't necessarily expect those stocks to rebound quickly, because there's still a lot of question marks about what's going to play out here. So if anybody stands to benefit, it would likely be industrials, maybe tech hardware players, possibly home builders, but it's still too early to tell who may benefit and what effect this decision will potentially have globally and here at home. All right, one final note: at EverThrive, we are a data-informed team. We really work hard to focus on you and your money, and we care about each one of our clients individually, and we want to see you thrive in every area of your life. So if you're not yet one of our clients and you want EverThrive to work for you, please feel free to scan this QR code or schedule an introductory call with us. Keep in mind that we offer services like active portfolio management. We help you figure out your risk tolerance and offer risk management solutions, personalized investment advice. We can give you rollover guidance on your 401k accounts or any employer-sponsored retirement plans, your IRAs, your Roth IRAs. And then we also offer comprehensive financial planning on a variety of topics. So if you are interested in learning more, please feel free to reach out to us. We love having you join us for the videos. Thank you for watching. Thank you to our clients. Thank you to our subscribers. If you haven't yet subscribed, click the subscribe button to do so, and I will see you again very soon.